Thanks for joining us at this Magellan Update. Today I'm speaking with the co-founder and lead portfolio manager and chief executive, Hamish Douglas. Hamish, around mid-August, you moved part of the strategy to cash. Can you recap on some of the reasons that drove that move?
Well, Frank, the main reason we moved to cash in mid-August, and I should say it's a 10% position, so we're not predicting there's about to be a market crash. But we had really felt from looking at all the data there'd been a massive compression in risk premia over the last 12 to 18 months. And this compression is on a historic precedent. If you look in Europe, the yield on 10-year bunds, German government bonds, is sitting below 1%. And if you look at the risk premia between bunds and the US Treasuries, they've widened to their widest levels. So the question is, are people being paid the appropriate premium between US rates and European rates? And then secondly, if you look at more risky European sovereign bonds like Spanish and Italian bonds, their risk premiums over the German rates are at all-time record levels. You could go through corporate credit, we could go through high yield credit. We've even seen in the equity markets where there's been a massive compression in returns between riskier, higher volatility equities and very low risk equities. And when we looked at many of these spreads and absolute levels when they're all-time record levels, and we'd seen a massive amount of issuance, particularly in the credit markets, we then started to focus on what could change this. Is this going to persist? And it could. Is this going to persist for a long period of time? Or could we unwind these low rates and increase the risk premia that would be in asset classes, which means prices go down? And we're really focused in 2015. We're starting to think about, is the Federal Reserve going to end quantitative easing? Of course, it's going to end in October, end of October this month. But then when they're going to start to increase rates, and we think it is very likely sometime in 2015, and there's a big debate about when that is, rates will start to increase in the United States. And when that happens, you could start to see an unwind, and it could be quite volatile. So when prices are very high, we thought that it's very unlikely that equity prices are likely to charge ahead in this environment. And there is a material risk, not a certainty, but a material risk. We could get quite a lot of volatility in markets and a reduction in prices. And that's primarily the reason why we moved to cash in mid-August this year.
And Hamish, that move to cash, the timing looks almost spot on given the recent few weeks of volatility. Has that surprised you?
Look, many things surprise us in markets, Frank. We don't try and time markets. We were looking out into 2015, so we were taking an 8 to 12 month view of when it happened. We weren't predicting literally 4 weeks later we're suddenly going to get volatility emerging in markets, and this volatility could disappear again. So whilst you're saying the timing looks near spot on, I think it's well too early to judge whether our timing, and I said originally when I wrote to investors, we thought we could have well been too early, and we may still be too early on this move, but it's better to be 6 months too early and 6 minutes too late. But the timing in a short judgment period, yeah, there's been some more volatility, but we weren't predicting that in such a short period, Frank.
So Hamish, given the recent volatility, and obviously there are some buying opportunities potentially, do you see yourself deploying some of that cash back into equities?
Well, we're evaluating that all the time. Our judgment is it's too early at the moment. We've seen some volatility, but we think we're very early in this episode, and we could see a lot more volatility to come. We really need a lot more direction from the data and from the Federal Reserve where it's going to move on interest rates, and we need to see how markets react to that. So there's short-term noise, I would call it, with a bit more volatility, and certainly some share prices have come back somewhat, but I wouldn't say they've come back into territories where we're suddenly seeing screaming buys in things we're really interested in. So a bit of prudence and patience is required here, I would say.
And Hamish, there are lots of socio-economic tensions out there in the world at the moment. Are any of them, from an investment perspective, of concern?
Well, there's a number of them, Frank, which of course creates uncertainty in the world. The most recent one is obviously the Ebola pandemic potentially starting in West Africa, and we're starting to see transmissions from obviously healthcare workers coming back to Western world countries, if for some reason it could start spreading rapidly in the Western world, that could cause a very big shock. I think one of the big unknowns in the world, a black swan event, it would be a global pandemic or a big terrorism event in the world. They're very, very hard to predict. At the moment, the health officials say it's very hard for Ebola to be transmitted. It can't be transmitted via the air. So hopefully that isn't going to be an issue that's going to be a big investment issue, but something we're watching. We have the situation in the Middle East, more uncertainty with what's going on with ISIL at the moment. Unless it caused a major disruption to the world's oil supply, again, we don't, obviously very worrying for the world, increases the terrorism alert potentially, but we're not really monitoring that from an investment perspective. What's going on in Russia and the Ukraine, that's been a lot more relevant to us from an investment perspective. I guess our view is that Putin is probably unlikely to politically back off from the position in the Ukraine, and it's unlikely beyond sanctions the West appears like it's going to take action in a military sense against Putin. So that sets the situation that this is unlikely to resolve itself in the very near future, and the most likely response are going to be economic responses. And because they're economic responses, that's obviously much more of an issue from an investment perspective. And these sanctions and then counter-sanctions for any businesses that could get caught up in that, and Europe, because they've got a lot of trading relationships with Russia, that's not good with what's going on in Europe at the moment. And what we've done in the portfolio over the last 6 months, we've materially reduced our exposure to businesses that have material exposures in Russia. So we've sold out of Adidas, which has a large Russian business. We've sold down our position in Danone, and its largest position is in Russia. And we've sold down McDonald's somewhat to Russia. And you've seen very interesting counter-sanctions on McDonald's, where Russia has started shutting down McDonald's restaurants on the basis of sort of health checks. I would say it's a quintessential American company, and it's an example. So we've been cautious around that, and we've been surgically trying to reduce the risk, and we're very nervous about the ruble and some other effects. But they would be the big socio-economic things we're looking at. Russia, Ukraine's probably at the top of the list from our investment portfolio perspective.
Hamish, as at the June quarter, and I know you don't focus on short term, but the June quarter performance seems to have turned around relative to some of the benchmarks that you monitor the fund against versus the September quarter. Can you just make comment on that?
Yeah, well, if you looked at the end of June, and I wouldn't look at a quarterly number, but if you look in the 12 months to June, our strategy was meaningfully under the MSCI World Index, 8 or 9 percentage points over the 12 months. And now we look at 12 months at the end of September, that's almost reversed itself. We're within a few percentage points over 12 months now. I think what we've seen is we've seen the increase in volatility. Obviously our move to cash has worked out reasonably well, but the biggest event is what the market is pricing has changed somewhat. We're a low volatility strategy. So when there was no volatility in the world and a massive compression in risk premia, very high quality, low volatility stocks performed much less well. They still were up strongly in that period on a 12-month basis, but some things raced ahead where people went into riskier equities, and because of this latest bout of volatility, a lot of that has reversed itself, and we are a quality, low volatility manager. So there's quite a lot of style what's happened over that period, and I think the strategy's doing at the end of June what I'd expect it to do, and given what's happened in markets subsequently, the strategy's more or less doing what I'd expect it to do as well.
Okay. And within the portfolio, are there any stock-specific concerns at the moment?
Well, the company with the biggest business issues at the moment is clearly Tesco. It's all over the news around the world. We hold a relatively large position. It's not in our top 10 anymore. It's less than 4% of the portfolio. Unfortunately, that's because it's fallen so far in price, not because of any great judgment I have made. I actually haven't sold or bought any shares, but it's fallen out of the top 10 because the price has come off very substantially after a number of profit warnings by the by the company. So that's clearly an investment mistake from myself. Primarily, it was a judgment call we were making that they were going to fix the US and China, which we've been right on. It's a judgment call that the businesses in Asia are incredibly valuable and are underappreciated by the market. Whether we get value for them or not will depend upon what the new management team does there, but we have some hope that we will get some value out of that. So hopefully we'll be right in the second thing. Still early to judge. What's happened in the UK, we were looking at a 3-year turnaround of their large format stores as part of our investment case. And what's happened in the short term, the profitability has fallen off a cliff. We were not predicting that, and clearly we've been wrong on that. And when we went in between £2.80 and £3, we believe there was relatively limited downside, but there was a potentially turnaround story in getting out of Asia and some other things. And clearly the stock price has fallen very materially. So there are significant business issues going on in the UK, but the stock's now down about £1.80. So am I concerned about the stock at £1.80? I'm actually not that concerned about the holding. We're doing a lot of due diligence on the company at the moment. We've got a lot of people working on what we think the strategy needs to be going forward from here. We're going to spend quite a bit of time with Dave Lewis, the new chief executive, to try and understand where he may be coming from. Obviously, they've got half-yearly results coming up this month, and hopefully he'll have something to say. It will probably still be too early. We'll probably have to wait for another 6 months before he has some clearer water. But at £1.80, we're relaxed that there's a lot of optionality there. Are we disappointed? Clearly we're disappointed with what's gone on, but making mistakes is part of the game. You just have to maintain a high batting average in this business.
And Hamish, the current positioning of the portfolio, are you comfortable there?
Yeah, we are actually very comfortable with the positioning of the portfolio, and particularly comfortable with the change in the risk profile. We run a low volatility strategy, but we were running pre-mid-August about 0.8, which is the beta cap of our strategy. We're now below 0.7 with our move to cash. So we've reduced the volatility characteristics of our portfolio even further. We've got our cash all being held in US dollars, which we believe is the right investment call. And if you look at the portfolio, even with the cash holding in the stocks that we hold, we still believe the portfolio over the next 3 years, even holding that cash, has the potential to deliver us returns in excess of our gross 10% per annum return objective over the next 3 years. So whilst we see more volatility potentially coming up, we think the portfolio is well positioned for volatility. But what we own, we actually like the companies, what we own. So we're very comfortable about the portfolio at the moment. I think it's well positioned. If there's no volatility, I think the more probabilities we get some volatility, and we've kind of dialed down the risk for our low risk strategy, that we would expect it to do pretty well in that environment. That doesn't mean if we get a big downturn in markets, our portfolio is going up, but we would expect that it's pretty well positioned if that was to occur. And if it doesn't occur, we think the portfolio is still pretty well positioned.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching. As always, feel free to forward on this video link to clients that you think might be interested. Thank you.